Right, thank you for attending. Today's webinar is on the do's and don'ts of MetaTrader for backtesting. In terms of agenda and prerequisites, it is expected that attendees have experience using MetaTrader 4, in particular the strategy tester, and that they also have experience in trading strategy development. In terms of agenda, we'll go through a brief introduction, discuss the motivation behind this webinar, followed by best practices for MT4 backtesting. And I've divided these into three categories today. The first, data handling, is where we will talk about how to treat data used in MetaTrader 4 backtesting. The second, parameter selection, is where we'll discuss parameter selection best practices in terms of risk management and strategy optimization. And finally, variable factors, where we will discuss considerations that trading strategies can benefit from during the design and post backtest phases. We'll conclude with a Q&A session where I encourage you to ask as many questions as you like about the content that we've covered today. So let's move on to the introduction, the motivation behind today's webinar. And I thought it best to use this comical graphic as it best demonstrates the motivation. So here we have a gentleman standing in front of what appears to be a displeased audience, trying to possibly explain why the project or performance of whatever it is that curve on his board demonstrates, why it hasn't gone according to plan. And I thought that inserting this was a good way to sort of it was representative of the dilemma or the challenge that traders face every day in backtesting versus live trading performance. And therefore, this sort of adequately represents that fact. In doing so, we'll talk about best practices, as I mentioned earlier, for backtesting trading strategies and MT4 strategy tester. And the other key points in today's presentation will be centered around backtesting a strategy correctly, how it increases the probability of the strategy generalizing well to unseen market data in future, and the need for a robust process to ensure synchronicity between historical and live performance. So let's begin with data handling, and in that we will talk about segmenting historical data first. Now, a common misconception in backtesting among traders is to associate a strategy's robustness with how well it performs on the largest possible amount of historical data available to the trader. So you will undoubtedly have come across situations where you've seen claims of a strategy holding up over a long period of time, say 12 to 15 years. This strategy, for example, a strategy performs really well over a long period of time and is sort of invincible. So those sorts of claims, in fact, are a misconception, because what we're actually faced with is that a strategy that performs remarkably well on the entire data set, especially a very large, very long data set, is at risk of being overfit or demonstrating high variance, as we put it. Conversely, a strategy that's been backtested on too small a portion of historical data is likely to encounter high bias, as in it's not able to generalize well to the data, to any unseen data that's presented to it. Similarly, quite similar to a strategy that's been overfit to data, so that when that strategy is presented new market data, even that strategy can't forecast accurately. So the misconception that training a strategy over the entire data set is advantageous tends to get a few traders into trouble. And therefore, at the very least, backtesting should be conducted using independent training, validation, and test sets. And this is something that we borrow from the machine learning world, where this is bare bones paramount in order to begin any form of analysis. The training set is the data segment used for training the strategy parameters on, or in other words, checking for decent performance. And the validation set in our presentation's context here is a part of this training set. It is the first unseen data segment used to test how the same parameters that were chosen in the training phase perform on unseen data. So think of the validation set as guiding the training phase, and passing this phase adds confidence that the strategy is likely robust. And any discrepancies in this phase also permit revision of parameters before finally testing on the last batch of completely unseen, held out test data. So in other words, in sample and out sample, out of sample, where in sample has been divided into training and validation sets, and out of sample is just the test set. So what this looks like is this. We have the original set in the very beginning. That's your entire history available to you. Let's say that is 15 years or 10 years. And what we do first is divide that into a training and test set, and we further divide the training set into two more sets, the training and validation set. We train the model or your strategy on the training set, and we validate on this set. Once we're happy with the validation results, we then proceed to see if that training validation routine resulted in a strategy that performed similarly in a testing environment with completely unseen test data. Let's now talk about length of data, selecting the appropriate length of historical data. And one thing must be kept in mind is that the amount of historical data required for a backtesting exercise is directly proportional to the complexity of the trading strategy. One moment, I'm just getting some questions here. I'm quickly going to yes, if we could kindly keep our questions to the end of the webinar. We have a dedicated Q&A session where I will answer every single question to do with the contents of today's presentation. So thank you so much for your patience at this time. So as I was saying, the amount of historical data required for a backtesting exercise is directly proportional to the complexity of the trading strategy being tested. So what that means is generally, more parameters require more data. So the more complex your strategy is in terms of number of parameters, the more data you're going to require to backtest, to validate the strategy, the hypothesis. And if the amount of available data is insufficient as the number of parameters grows, then there are other approaches that can be employed to make use of a smaller sample of data than is optimal. So these include cross-validation, and or walk-forward optimization, terms that you may have come across in the past. There is another approach called bootstrapping. This too is a possibility. However, we must be careful when employing bootstrapping on time series data, particularly where time series data exhibits variable momentum over short periods of time, and it becomes considerably difficult to preserve dependency structure when employing bootstrapping with such data. So even though it is a possibility worth exploring, care must be taken when employing bootstrapping in particular. Next, we proceed to the sample size of trades in a backtest, and this is a point that's been contributed by Klondike FX, one of the best traders on the Darwin Exchange. And he says that if you have a strategy with a small number of trades, the relevance of the backtest is significantly lower than of a strategy with a large number of trades. And this makes complete sense because the sample size of trades in a backtest is an important factor, and therefore the sample size of trades in a backtest is another factor to consider when answering this question. How indicative of future performance is this backtest that I'm observing right now? And that is a question that can be adequately answered the more statistically significant your results are. Next, we move on to backtesting timeframes on timeframes lower than the hourly timeframe. So strategies that trade below the hourly are prone to experiencing excess divergence between their simulated and live trading performances. And this behavior is primarily due to a considerable amount of noisy data on timeframes below hourly. And we will touch upon why this noisy data exists and some factors in MetaTrader 4 itself that make the problem slightly more challenging. We'll talk about that shortly. If a strategy models on data over small timeframes, then traders have to be mindful of any overfitting risk, particularly in complex strategies with a large number of parameters, as I mentioned earlier. And then we have Monte Carlo simulations that are a good way of simulating over robust variations in strategy parameters. This approach can quickly estimate how closely or not your trading strategy could perform in live trading versus backtesting by throwing thousands of runs of multiple variations in strategy parameters. You can get a fair idea of how overfit or underfit your trading strategy is to the data modeling it on. In terms of MetaTrader 4 itself, let's discuss the effects of interpolation as regards historical data in MT4. Data on timeframes lower than hourly, the hourly H1 timeframe in MetaTrader 4 is progressively affected by something called 1-minute interpolation as the timeframe decreases. So as you go down from hourly to M30 to M15 to M5 to eventually M1, which is the lowest precision available in MT4, you're going to see the effects of interpolation increase as you lower the timeframe. And this has implications for trading strategies that are backtested on small precisions of data or too sensitive timeframes. The probability of live trading results differing considerably from backtests therefore increases as you decrease the timeframe due to this interpolation issue. And the solution to this issue is choosing robust parameter ranges and always comparing a strategy's performance on lower timeframes with higher timeframes, as well as multiple data sets on both lower and higher timeframes. And if these differences, when you test across timeframes and you test across different sources of data, if these differences are excessively large, for example, say we have a fairly profitable strategy on the 15-minute time frame, M15, and that fails on higher timeframes or fails on the M15 timeframe on a different data set, then the probability of this strategy being overfit to your data set is usually fairly high, especially because it's a low time frame. Revalidating MetaTrader 4 history center data. This is really important and is something that's specific to MT4 and not very well documented, so it's worth mentioning here. Data in MetaTrader 4 can at times experience corruption during platform usage, and this can happen as a result of several things. It could be discrepancies in tick data transfer. It could be opening charts on assets where that history wasn't already available in your history center. These are a few reasons that could cause this corruption. And therefore, when you're backtesting in MetaTrader 4 using the strategy tester while you're connected to your brokerage account, you must refresh asset data in the history center again prior to executing any new backtest. So say you've backtested once and some time has gone by and you'd like to conduct another backtest and you've been connected to your brokerage account all this time. You want to go into your history center, download data again, just press the download button to refresh the history center data, and if it asks you to recalculate data on old timeframes, you go ahead and do that too. This ensures that the data is up to date again, and any erroneous ticks or gaps as a result of market opens or 1-minute interpolation, as we talked about, discrepancies due to that, or any high impact news events that have caused fluctuations in price that haven't been recorded properly in MetaTrader 4, that these issues are validated prior to your next backtest. Now we move on to the section, the category of parameter selection, since we've talked a lot about data handling. And let's discuss robust parameter ranges to start with. So regardless of the number of parameters you have in your strategy, choosing parameter values that do not fit the underlying data too closely is a good practice. So for example, it's a more robust practice to use an EMA, an exponential moving average, period of say 50 instead of 49 or 47 or something very specific like that. Round numbers generally demonstrate robustness if the strategy holds up on those numbers. And if the resulting backtest performances are slightly different but positive in both cases, then you know that you would probably you should choose the simpler of the two, the more round, the more robust of the two numbers. Also in line with that, something that was contributed by Klondike FX, again, you must keep an eye on the distribution of profitable strategy parameters. So if the strategy is highly profitable with, using that same example of the EMA, is highly profitable with an EMA of 50, but unprofitable with say 55 or 45 on either side, then it's likely that the 50, the strategy being profitable on the period of 50 is an anomaly. And you should be particularly careful going forward. So the moral of the story here is that traders can often get wrapped up in a strategy functioning really well on a certain parameter set. And that creates the illusion of an inefficiency that this strategy can exploit all throughout time. Therefore, it's possible that you're essentially just overfitting to an anomaly, and you must therefore watch out for such anomalies. Also, during genetic or walk-forward optimization, it's good practice again to choose robust parameter values that increment in steps of 5 or 10 as opposed to 1 or 2. So, for instance, if you're you're optimizing a trading strategy's parameter space, and you have the option, you have X parameters, and each of them takes a value between some number and another number, it's more robust to optimize where you increase that number by 5 or 10 as opposed to 1 or 2, because undoubtedly by choosing 1 or 2 you may end up again overfitting to the data in the optimization. So that has two problems. The first problem is that the optimization results won't really help you decipher which parameter space is better than the other, which parameter value space is better than the other. And secondly, you might end up choosing a set of parameters that's essentially overfit because you've chosen such small increments. Therefore, it's a very good idea to choose robust increments like 5 or 10 when you're optimizing or walk-forward testing. Robust range selection in this manner, however, does carry the risk of introducing bias into the algorithm, which essentially means that by choosing too robust or let's say too simple a value space, you may end up forcing your strategy to not really generalize too well to unseen data. So there is that risk, and therefore it's important for traders to test how using these robust parameter values impacts the overall performance or the ability of the strategy to generalize well to unseen data. Let's talk about selecting the number of parameters or degrees of freedom. And again, a contribution from Klondike FX, where the higher the degrees of freedom or the number of parameters, put differently, that are available to a trading strategy, the higher the likelihood of overfitting. And this is very true. Traders must therefore be very careful when backtesting strategies over large parameter spaces. Remember, the larger the number of parameters you supply your strategy to trade with, the more options it has to fit to the data it's been modeled on. If you continuously do that, you may end up, even with a robust range of values for each parameter, you may still end up with an overfit strategy because you're using so many parameters. So the performance of an overfit strategy in live trading will very likely be surprisingly different to your backtest. So be mindful of the number of parameters, or put differently, degrees of freedom that you allow your strategy to trade with. Estimating the impact of variable spread and slippage is a very, very important issue, and is not MetaTrader 4 does not help very much in this particular area. So at the present time, October 18, 2017, MT4's strategy tester does not yet ship with the ability to backtest with variable slippage. In any DMA brokerage environment, you will undoubtedly encounter variable slippage because your orders are going straight through to the market. Traders can, however, run slippage simulations on their backtest results in a few ways. This is after your backtest is complete and you've extracted the report from the strategy tester as a detailed report or a simple report. You can import the backtest results, the HTML report that's generated by MT4 into a spreadsheet application, say MS Excel. You simply copy paste your results into MS Excel, modify the open and close prices of these trades with, say, randomly generated values between a sensible range, say between 0.1 and 2 or 0.1 and 5, and finally recalculate your P&L. So what you've effectively done is created your own variable slippage tester by simply copy pasting your results into Excel and allowing Excel to recalculate with randomly chosen differences, as I just mentioned. So this is really important because then you can visualize the impact this has on your P&L. You can also use Excel or any other spreadsheet application to chart this behavior. You can draw your original equity curve, your original balance or equity curve, and draw all the curves with all the various changes you made in applying that slippage or spread to your open and close prices, and then see what it looks like. It's a very good practice to do that. Unfortunately, MT4 doesn't allow us to do that, but if you have any knowledge of any sort of spreadsheet application, doesn't have to be MS Excel, you can implement this really easily without any fancy software. Slippage simulation can also be done by importing backtest results, of course, into a statistical computing environment such as R or Octave or MATLAB, if you're familiar with those packages, and doing the same as I just mentioned with the spreadsheet. So anything that can be done in a spreadsheet application can also, of course, be done in a statistical environment, and of course, a lot more can be done in such environments than in Excel. And your last option is, of course, there are various third-party commercial tools available that allow you to simulate variable slippage and variable spread, and those of course are beyond the scope of this presentation, but those are there for you to use as well. Same with variable spread, as we talked about variable slippage all this time. MT4 currently ships with fixed spread testing available in the strategy tester, and this doesn't solve our variable spread issue. So again, you can follow this exact same exercise, taking your data once you've exported it from your strategy tester, copy pasting it into a spreadsheet application, or importing it into a statistical package like R, Octave, or MATLAB, and doing exactly the same simulations. Now, maintaining stable underlying strategy valued risk. Very, very important, particularly for people who take their trading strategies onto submission for Darwin status. If you create a Darwin, then it's important that you need to maintain as stable an underlying VAR as possible. And making use of dynamic stop loss and take profit targets that are proportionate to available account equity is one way to do that. This allows for realistic backtest outcomes. You don't get, for example, you don't get carried away with disproportionately increasing lot sizes as your account equity increases. You can make for realistic backtest outcomes, choosing sensible dynamism in your strategy, and what that translates to is sensible risk per trade in percentage terms, percentage proportionate to available equity. That's a good practice and allows you to maintain a stable VAR. It aids risk stability, in particular, the risk stability investment attribute, especially if the trader intends on creating a Darwin, because as you know all too well, maintaining stable underlying VAR will result in maintaining stable Darwin VAR, and that is very, very important during trade replication. In trading strategies that increase or decrease position sizes by available equity, it is particularly important that minimum and maximum lot sizes be restricted to sensible ranges. And this is for the following reasons. So a lot size dropping below the minimum permissible lot size would result in your trade getting rejected. So that's quite obvious, but more importantly, lot sizes scaling too large in single trades. For example, one trade at 100 lots or above, that's quite a large number, even 10 lots, 20 lots or above, would introduce capacity constraints during live trading. And this is something that's not adequately, that one can't adequately model in the MT4 strategy tester unless you really put a lot of effort into sort of extracting the data and then doing simulations outside of the strategy tester. One temptation when backtesting is to give a risk percentage per trade, let's say. In the spirit of talking about stable underlying VAR, say a trader specifies a particular risk per trade in percentage terms, and they backtest over, say, a 15-year period. If this strategy is already overfit to this data, and the trader has specified a percentage proportionate to account equity, then that strategy will go without a maximum limit on the lots per trade. That strategy will probably take trades at 500 lots, 600 lots, 700 lots, if that's permissible in the testing environment, and give you a very unrealistic backtest, because in reality, there are capacity constraints, there are scalability issues to consider, and a strategy it's extremely unlikely that a strategy will get away with executing one trade at 500 lots in live trading without encountering some form of slippage or rejection or something along those lines, or capacity constraints that will cause massive divergence issues for investors in a Darwin following such a strategy. So it's very important that you specify stable risk percentages proportionate to available equity, but B, more importantly, that they are sensible and that they have sensible maxima. And that's something to take away from here, because the temptation is there to always use an uncapped maximum, and in reality you must have capped maxima to basically ensure that you have a stable, realistic backtest outcome that you can then assess further whether it's worthy of taking live or not. Capacity constraints, as I was just talking about, could then require fractional position sizing to address the issue, depending on factors such as the time of day, strategy capacity, and available liquidity. And fractional position sizing is the simple practice of, if your strategy is now placing trades that are fairly large, or let's take a step back. If your strategy only places one trade that per signal generated by your strategy, that is a less scalable practice than, say, executing a number of trades that equal the same exposure, same lot size. So if you were, for instance, executing one trade of one lot, then it would be a more scalable practice to, say, execute 5 trades of 0.2 lots or 10 trades of 0.1 lots each. So the more scalable you make your execution, the more scalable your trading strategy becomes, and therefore the capacity of your Darwin or your trading strategy improves organically. These issues are not visible in the MetaTrader 4 backtest, and without being factored in can create the illusion, as I mentioned earlier, with an uncapped maxima in a trading strategy during a backtest. It can create the illusion of an extremely profitable trading strategy with no liquidity or capacity constraints affecting it. So this is something that traders need to be mindful of when doing any form of backtesting in the strategy tester or not. Finally, we talk about some variable factors that help traders during both the design phase of the trading strategy as well as the post backtest, after the backtest is done. Correlation of strategy returns to market volatility. This is a very important consideration that we've covered in quite a lot of detail in a previous webinar on the effects of market volatility on trader performance. It's on the DarwinX YouTube channel. If it's possible for you to quickly write down this URL, that would be fine, but of course the more sensible thing to do is to just go to YouTube, to the DarwinX channel on YouTube, and search for effects of market volatility on trader performance. And if you're interested in the impact of correlation of strategy returns, the study of correlation of strategy returns to market volatility, that webinar recording is definitely worth your time. Testing for market correlation. This is another important aspect to consider. Comparing the correlation of a trading strategy's returns to those of its underlying assets will reveal how dependent the strategy is on those underlying assets. So a strategy with a lower dependency on the assets it trades is less likely to demonstrate unexpected behavior during periods of, let's say, decline or sudden turbulence in the underlying assets. So say a trading strategy is modeling on the euro dollar and the British pound dollar. If it relies too much on those two assets, the movements of those assets, that it therefore has a high dependency on the movements of those assets, and is therefore subject to the risks those assets may face at different periods of time. As opposed to a strategy that does not rely so heavily on the underlying asset returns, because A, it trades them in both directions, and B, more importantly, it trades them in a manner where the strategy's returns don't correlate with the individual or combined returns of the portfolio of assets that it's trading. So it's important to keep an eye on the dependency of the trading strategy on the underlying assets. To analyze a strategy for market correlation, of course, as well as 11 other investment attributes, traders are encouraged to upload backtests to the DarwinX platform. This is the easiest, most sensible way of assessing your trading strategy. The backtest of your trading strategy after you've done the MT4 backtest is to upload your backtest results into the DarwinX environment and get scored for 12 investment attributes, one of which is market correlation, and the other 11 include all the way from experience, open close, sensitivities, open close percentages, different excursion based attributes, etc. So very, very important that once you've gone through your original backtesting in the strategy tester, that you upload your backtest to the DarwinX platform and get analyzed based on our 12 attributes. Optimizing position sizes for capacity. So a strategy's overall investment capacity can be improved, as I mentioned earlier, by implementing fractional order sizing as opposed to fixed singular lot sizing. As I mentioned earlier, for example, sending 10 orders of one lot each, or in my example earlier of zero point 0.1 lots each, is more scalable than sending one order of 10 lots. So if you have every signal generating a restrained or a restricted number of trades, try to see if you can implement fractional order sizing, where you divide your position into a number of trades as opposed to just executing the position over one or a very small number of trades. That generally improves the scalability of your trading strategy. For detailed discussion on scalability, there is a very good webinar recording on scalability, as it used to be called. Now it's called capacity, on the Darwin Exchange, and this too is available on the DarwinX YouTube channel. So simply go to the DarwinX YouTube channel and search for scalability, and that webinar recording should come up there after. Finally, trading high impact news, something that is very difficult to model correctly in the MT4 backtester. Strategy tester. Strategies that trade during high impact news events are, as you know, impacted negatively by sudden swings in variable slippage and spreads in a DMA environment. So this risk can't be quantified well in MT4 backtest. It's not backtests. It's not reflected there too well, and some news trading strategies can therefore present the illusion in backtesting of being quite successful. What you can't model at the present time in MT4's strategy tester is variable slippage and variable spread, the two things that come full force during a high impact news event. So if those can't be modeled appropriately, a backtest that models a news trading strategy is prone to those additional risks, that it is possibly not representative of how that strategy would behave in a real high impact news situation where you have variable slippage, variable spreads, and a host of other factors. Disabling trading, therefore, at predefined times or intervals corresponding to news events can favor overall improvement in backtest accuracy. So these are things to consider. And finally, we have our Q&A session. Thank you very much for bearing with me, and there's quite a lot of material to cover, but I now invite you to ask as many questions as you like about what we have covered today. So we have a question here about, let me just open the questions window. We have a question about parameter spaces in optimization, it appears. What is the best parameter space to choose during an optimization? This is completely dependent on your trading strategy, what the parameter spaces take as inputs in your trading strategy. But the best practice when optimizing or forward testing over your parameter space is to, as I mentioned earlier, to use parameter increments that are robust and sensible in terms of, let's say, if you're backtesting or you're optimizing a parameter and it takes any value from 0 to 100, it's a more robust practice to choose increments of 5 or 10. So do an optimization over 5, 10, 15, 20, 30, 40, etc., or 10, 20, 30, 40, as opposed to 1, 2, 3, 4, 5, because with the latter, the increment of 1 or 2, the likelihood of you overfitting to your data is increased quite exponentially, as opposed to choosing a more robust increment like 5 or 10. Any other questions? We have another question about slippage. How do I model slippage in the MT4 backtester? It's not possible, unfortunately, at the present time to model slippage in the strategy tester because it doesn't allow us to incorporate variable slippage. So there are a few ways to simulate this activity on your own. You'd first go ahead and conduct your backtest as you would normally. Once you've got your backtest complete, export the results into the detailed report or standard HTML report that you can get out of the MT4 strategy tester. And you can do a number of things with it. So you can copy paste all the trades in your backtest into a spreadsheet application like Excel. And you can modify your open and close prices for each trade with a randomly chosen value that's representative of what slippage could be like. So if the more aggressive you want to be with this, you could slip every trade by 3 to 5 pips, for example, if you wanted to be really aggressive, or you could slip it by anything from 0.05 to 1 pip. Or if you wanted to model a high impact news event, you could choose a particular subset of trades during those high impact news events and slip your trade randomly between 0.01 and 10 pips, for example, or more. It's totally up to you, and it's totally up to the use case, what exactly your strategy is modeling, at what time it's modeling it, and what sort of market conditions persist at that time. So there's that option of doing that inside a spreadsheet application. And the other option is if you are familiar with statistical environments like R, Octave, or MATLAB, you could import the strategy tester's report into those environments and do a number of things other than just slippage simulations there. And then the third option is there are commercial tools available. Unfortunately, they're beyond the scope of this presentation, but those commercial tools built on top of MetaTrader 4 can also allow you to simulate variable slippage and variable spread during your backtests. Any other questions? Great. So I hope you've enjoyed the content today, and we've covered a lot of material. I appreciate in a short period of time. Any questions that I've missed here or that you feel weren't covered thoroughly enough, please do email info@darwinx.com, and either myself or one of my colleagues will reply with an answer as soon as we can. Other than that, I'll see you on the next webinar, and thank you for your attendance today. Thank you very much, and have a great evening.